Horrible inflation CPI report of June 2022. Hi everyone, this is Nir with Financial Whales. Welcome to the channel, and today I want to talk about the CPI report we had yesterday and what it means for stocks and real estate. I'm also going to talk about why the US dollar is getting stronger in comparison to other currencies, and by the end of the video I'm going to talk about the second quarter earnings season that has already begun this week, and are we going to have an earning recession and what it means for the future of the markets. Thank you so much for joining us, guys. With that being said, let's get right into the video. US inflation is coming in hotter than the forecast, and in fact, this is the hottest inflation report we had in the last 40 years, and also the biggest gain we had since 2005. So we expected to see 8.8% year-over-year inflation and 0.5% in the months over months. What did we actually get? We got a horrible 9.1% year-over-year and 1.3% month-over-month, which represent about 15.6% annual in inflation. Guys, this is a total and complete disaster, and this is far from the expectations economists have predicted for us in the past couple months, and it's definitely showing us that inflation hasn't peaked like we were told to by the media. I remind you folks, last year, economy officials have said that inflation is transitory, and today they use the word peaked as it's the new transitory. If we go really quick to the website of the US Bureau of Labor Statistics, we can see inflation is standing at 9.1% for June 2022, which is above the inflation we had back before the Great Recession. If we go a little deeper into the report, we choose the energy item and we see we have a massive spike of 41.6% in energy prices. Electricity prices have gone up as well substantially, 13.7%, and shelter have gone up as well, 5.5%. Food have gone up 10.4% in June 2022, and of course, as we all know and feel at the pump, gasoline prices have gone up substantially, 59.9%. Now guys, let's remember the government way to measure CPI is a little bit shady, and it was changed in the 1980s in order to manipulate the data and help the market recover. Look guys at this tweet brought to us by Wall Street Silver. This is the chart. If we would measure inflation today like we did before the 80s, it would be around 17% and not like the 9.1% we got yesterday morning. I remind you folks, the government way to represent us, the actual numbers is way more moderate than it is in real life, and real inflation is probably much higher than the numbers we're seeing in the report. By the end of the month, July 27, the Fed is meeting again, and we're expecting to see another interest rate hike. Already 100% of investors are pricing in 75 basis point hike by the end of July, and 43% of investors are pricing in 100 basis point hike by the end of the month. While I make this video, this number has already gone up from 43% of investors to 67% of investors. This article this morning from CNBC says that Fed Governor Waller says he is open to a larger rate hike this month than they had in June. I remind you folks, in June they have raised interest rate by 0.75%. And yesterday, Atlanta Federal Reserve President Raphael Bostic, when he was asked by the press what he think about a 100 basis point increase in interest rate by the end of the month due to high inflation report, he said everything is in play. Now, I just want to mention, guys, that Bostic and Waller, they both work for the Fed. They're getting paid by the Fed, and when they are talking to the press, they are saying whatever they have been told to say. In other words, that's the soft way of the Fed telling us that they are going to raise interest rate by 1% by the end of the month. A quick look at the Fed balance sheet showing us that the Fed has been purchasing assets since the last recession. When I say assets, I mean mortgage-backed securities and US Treasury bonds. After the pandemic, they have spiked their purchases and kept on printing money, and until May, only 2 months ago, they would be still purchasing mortgage-backed securities and US Treasury bonds. Now, when the Fed is raising interest rate, we're expecting them to also start loading off their balance sheet once they will do that, we are going to see a lot of pain in the short term for stocks, real estate, commodities, gold, and crypto. But the good thing about it is that it can lead us to a good buying opportunities if you are planning to be a long-term investor. In order to fight the inflation, or at least playing like they're fighting the inflation, because it seems to me like a whole puppet show, the Fed has to bring us to at least 3.5 to 4% interest rate as soon as possible to really reduce demand in the market and help bring prices down. I don't have a lot of expectations from the Fed. We have seen 2 years ago, how easily they can turn on the money printers in order to support the economy while they devaluing your currency. Here we are looking at the chart of the Dixie, which is the US dollar currency index. This is basically a chart that shows us how strong is the dollar in compared to other currencies, when the main currencies are the euro, the Japanese yen, and the British pound. And we can see this massive spike in the recent weeks as the Fed is raising rates and the dollar is getting stronger. Euro, on the other hand, is only getting weaker and weaker, and it's now in levels we haven't seen since 2002. The reason for that is because euro is actually relying on import energy from other countries like Russia and the US, and all these commodities are still being traded with dollars, which is very unfortunate for the European Union. And we can see how drastically the euro has fallen compared to the dollar in the recent weeks. Another currency that is falling in comparison to the dollar is the Japanese yen. This chart represents the USD dollar compared to the Japanese yen, and we can see that the dollar is only getting stronger and stronger, and this is level we haven't seen in many years. And the reason for that is actually not relying on energy imports like Europe. That's because the Japanese government has issued too much debt, and now while the Fed is raising interest rates, the Japanese government is actually reducing interest rate and cause a massive inflation and devaluing of their currency. Another currency I wanted just to bring to your attention, guys, is the Chilean peso against the US dollar. We can see how it's totally crashing in the recent days, and we're going to see more and more currencies like that in the near future as the Fed keep raising rates. Second quarter earnings season has already begun this week. This morning we had JP Morgan and Morgan Stanley with their earning reports, and tomorrow we have Wells Fargo, we have Citi, and US Bank Corporation. By the end of the month, 71% of the largest S&P 500 companies are going to report their earnings, and we might going to see an earning recession, because I do expect this quarter to be horrible for a lot of companies. I bring to your attention, guys, that the banks are reporting this week, because this can tell us a lot about the situation in the economy, and more than that, these reports can tell us a lot about the consumer and how bad the banks are predicting the next recession is going to be. We already know that mortgage departments are pretty much wrecked, but what we do want to see in those reports is the consumer, how much the consumer spend, what about savings, what about credit card debt, etc., etc. We are going to take a look deeper on all these things in the upcoming video, and of course I'm going to cover the companies that are going to report next week as well. If you made it in the video so far, thank you so much. I encourage you to hit that subscribe and like button, maybe even share it with a friend to help him to get informed about the current situation in the market. And with that being said, guys, thanks so much, and I'll see you on the next video.